The risk of the all-in-one approach. Why putting everything in one place can be dangerous. The all-in-one mindset in investing sounds efficient. One asset, one strategy, one conviction, one decision. It promises simplicity. But structurally, it increases fragility. 1. Concentration risk. When capital is concentrated in a single asset, outcome variance increases dramatically. If that asset performs well, returns look impressive. If it fails, recovery becomes difficult or impossible. Diversification theory, developed by Harry Markowitz, shows that combining imperfectly correlated assets reduces overall portfolio volatility without necessarily reducing expected return. All-in-one ignores correlation benefits. It replaces structural resilience with dependency. 2. Fragility to unknown events. Markets are influenced by regulatory shifts, technological disruption, macroeconomic shocks, management failures. Even dominant companies can suffer severe drawdowns. History has shown that seemingly untouchable firms can collapse or stagnate for decades. An all-in approach assumes future stability. Markets rarely guarantee that. 3. Behavioral amplification. Large concentration increases emotional intensity. When most of your wealth depends on one asset, price swings feel personal. Losses trigger panic. Gains trigger overconfidence. Research by Daniel Kahneman highlights how loss aversion magnifies emotional response under high stakes. High emotional stakes impair rational decision-making. 4. Recovery mathematics. Large concentrated losses are mathematically punishing. A 50% loss requires a 100% gain to recover. A 70% loss requires a 233% gain. Diversified portfolios typically experience smaller drawdowns. Smaller drawdowns mean faster recovery. 5. Overconfidence bias. The all-in-one approach often stems from high conviction, past success, belief in superior insight. Behavioral finance research shows investors frequently overestimate forecasting skill. Even professional fund managers struggle to consistently outperform broad benchmarks, like the S&P 500 over long horizons. Concentration amplifies the cost of misjudgment. 6. Liquidity and opportunity cost. Capital tied in one position reduces flexibility. When new opportunities arise, there may be no available liquidity. Reallocation may require realizing losses. Emotional attachment prevents objective decisions. Diversification preserves optionality. 7. Systemic versus idiosyncratic risk. All-in-one exposes investors heavily to idiosyncratic risk unique to a specific asset. Diversification primarily reduces this type of risk while maintaining exposure to systemic market growth. Long-term wealth building relies more on managing idiosyncratic risk than on predicting single winners. The structural problem. All-in-one feels simple, but simplicity is not the same as resilience. True structural simplicity means broad exposure, controlled downside, reduced single-point failure, not total dependency. Final insight. High concentration can create high returns. It can also create irreversible damage. Wealth built on one pillar is fragile. Wealth built on diversified structure is durable. The goal is not to predict perfectly. The goal is to survive uncertainty and compound through it.